Tonight, we're going to talk about something that's going to completely reshape how you think about the stock market, about economic health, about everything you thought you knew about what those green and red numbers actually mean. We're going to explore the most sophisticated economic signaling system ever created, a system that processes trillions of dollars of information every single day and tells us things about the economy that even governments don't know yet. And I have to warn you right now, by the end of this, you're going to look at stock market movements differently. You're going to understand something that most investors never grasp, something that makes even the daily closing prices seem like they're missing the entire story. If you enjoy these deep explorations into finance and markets, consider subscribing or hitting the like button. It really helps the channel grow and allows me to keep making content like this. Let's begin with something familiar. Your retirement account. Maybe you've got $45,000 in a 401k. You check it once a month, maybe once a quarter if you're disciplined about not obsessing. You see the number go up. You feel good. You see it go down. You feel anxious. Maybe you've got it in a target date fund, or a mix of index funds, 60% stocks, 40% bonds, the conventional wisdom. This is a scale that makes perfect sense to your brain because it's your future, your retirement, your security in old age. When that number is $45,000, you calculate, at this rate, if the market returns 7% annually, I'll have about $180,000 in 20 years. You run the numbers. You feel either comfortable or anxious, depending on what you find. You are one of approximately 58% of Americans who own stocks, either directly or through retirement accounts. That's about 145 million people. Most own very little. The median American household with stock holdings has about $40,000 invested. Your $45,000 retirement account is your tiny piece of the market. When the market goes up 1%, you make $450. When it drops 2%, you lose $900. These movements feel significant because they are significant to you. That's real money. Money you worked for. Money you're counting on. But here's what most people don't realize when they look at their portfolio balance. That number $45,000, or whatever it is, isn't just a reflection of the companies you own. It's not just about whether Apple sold more iPhones or whether Microsoft's cloud revenue grew. That number is a real-time aggregation of millions of investors processing billions of pieces of information about the current and future state of the entire economy. Think about what happens when you check your balance. Let's say you own an S&P 500 index fund. That fund owns 500 of the largest U.S. companies. Those companies collectively employ about 29 million people. They generate combined revenues of roughly $18 trillion per year, nearly as much as the entire U.S. GDP. When your balance changes, it's not random. It's the collective judgment of every investor in the market: pension funds managing trillions, hedge funds making millions of trades per second, individual investors moving their 401ks, foreign central banks rebalancing reserves, corporate buyback programs, mutual funds, all of it processing information and placing bets on the future. Your $450 gain isn't just $450. It's a signal, a tiny echo of something much larger happening in the economy. Let's zoom out slightly. You've been investing for 10 years. You started with $5,000 and you've been adding $200 per month religiously. That's $24,000 contributed over the decade. With market returns, you're now sitting at $45,000. You've gained $21,000, a 46% return on your contributions. Not bad. Actually, quite good. The market has been kind to you. But during those 10 years, you experienced volatility. In 2018, your account dropped 15% in 6 weeks. You watched $6,000 evaporate. It was terrifying. Financial media screamed about trade wars and Federal Reserve mistakes. You wondered if you should sell, cut your losses, wait for things to stabilize. You didn't sell. You kept contributing $200 per month, and the market recovered. By early 2020, you were back to all-time highs. You felt vindicated. You felt smart. Then COVID hit. March 2020, the market collapsed 34% in 5 weeks, the fastest bear market in history. Your $38,000 became $25,000. You'd lost more than 2 years of gains in a month. You saw the unemployment numbers, millions of people losing jobs every week. You saw businesses closing. You genuinely wondered if the economy would ever recover. And then, impossibly, the market turned. By August 2020, it had recovered everything. By December, it was hitting new all-time highs, while 10 million people were still unemployed. The disconnect felt absurd. How could the stock market be celebrating while the economy was devastated? This is the paradox that confuses most people. The stock market isn't the economy. The economy isn't the stock market. They are related, deeply intertwined, but they are measuring different things. The economy is now. It's current employment, current GDP, current consumer spending, current business activity. The stock market is the future. Its expectations about earnings in 6 months, 12 months, 5 years, 10 years. In March 2020, the stock market crashed because investors saw the future. Lockdowns, business closures, collapsing demand, potential depression. By August 2020, the stock market soared because investors saw a different future. Massive fiscal stimulus, Federal Reserve support, eventual vaccine, pent-up demand ready to explode. The market wasn't ignoring the 10 million unemployed people. It was pricing in the probability that most of them would be re-employed within a year or two, that government support would prevent mass bankruptcies, that the economy would recover faster than anyone expected. And it was right. By 2022, unemployment was back to 3.5%, lower than before COVID. The economy grew. Corporate earnings hit record highs. The stock market's August 2020 optimism turned out to be justified. This is what the stock market does. It aggregates information, processes probabilities, and prices in future expectations faster than any other system we've created. Now, you might have $45,000 in your retirement account. Your coworker might have $180,000. Your boss might have $800,000. These feel like vastly different amounts, and they are, to you personally. But in the context of the total stock market, they are all rounding errors. The total value of the U.S. stock market, every publicly traded company combined, is approximately $50 trillion. Let me put that in perspective. If you saved your entire $45,000 retirement account every single, never spending a penny, it would take you 1.1 million years to equal the value of the U.S. stock market. Humanity has only existed for about 300,000 years. Modern civilization is maybe 10,000 years old. You'd have to save for longer than our species has existed. Your $45,000 is 0.0000009% of the total U.S. market. Your gains and losses are real to you, but they're completely invisible to the market as a whole. But here's the thing. Compared to global stock markets, even the massive U.S. market is just one piece. And compared to all financial assets worldwide, stocks are a fraction. And compared to the information those stock prices contain about economic health, the dollar amounts are almost beside the point. We're about to climb a ladder of scale, each rung making the previous one look microscopic. From your retirement account to the total market capitalization, from market cap to trading volume, from trading volume to derivatives exposure, from derivatives to the actual information content embedded in prices. The journey will show you that stock markets aren't just gambling venues or wealth generation machines. They are the most sophisticated information processing systems humanity has ever created. They reveal truths about economic health that surveys miss, that government statistics can't capture, that economists discover only months later when the data finally comes in. Let's start small and build up. You own shares in your retirement account. Maybe you own 100 shares of an S&P 500 index fund, currently trading at $450 per share. That's your $45,000. What does that price $450 per share actually represent? It represents the collective judgment of millions of market participants about the future cash flows of 500 companies, discounted to present value, weighted by market capitalization, adjusted for sentiment, liquidity, risk appetite, and 1,000 other factors. When that price moves from $450 to $455, it's not random. Something happened. Maybe economic data came in better than expected. Maybe the Federal Reserve signaled they might cut interest rates. Maybe corporate earnings surprised to the upside. Maybe geopolitical tensions eased. Or maybe nothing specific happened. Maybe it's just the normal ebb and flow of buying and selling, supply and demand, optimism and pessimism washing back and forth across millions of transactions. Professional investors spend their entire careers trying to figure out which is which. Is this move meaningful or noise? Is it a signal about the economy or just random volatility? Here's what makes it fascinating. Even the noise contains information. When markets are calm, when your $45,000 slowly grows to $45,500 over a month with minimal daily volatility, that calmness is itself a signal. It suggests investors are confident about the future. They're not panicking. They're not rushing to sell. Business conditions are stable or improving. Economic uncertainty is low. When markets are volatile, when your $45,000 swings to $47,000 on Monday and back to $43,000 on Wednesday, that volatility is a signal. It suggests uncertainty, conflicting information, investors trying to figure out what's happening and what it means for the future. The VIX, the fear index, measures this volatility. When the VIX is below 15, markets are calm, investors are confident, economic conditions feel stable. When the VIX spikes above 30, markets are in panic mode. Something is wrong or uncertain, and investors are desperate for clarity. In February 2020, the VIX was 14. Calm, stable, no concerns. By March 16, 2020, the VIX hit 82.69, the highest level ever recorded. The market was screaming, "We have no idea what's about to happen, and we're terrified." That wasn't just volatility. That was the market processing the reality of COVID in real time, faster than governments, faster than health organizations, faster than economists. The market saw what was coming before almost anyone else. Now, you check your retirement account on your phone. A few taps and you see $45,234, up $127 today. Grain numbers. You feel slightly better about the world. But behind that simple number is a staggering amount of complexity. Your index fund owns fractional shares of 500 companies. Apple, Microsoft, Amazon, Google, Tesla, Johnson & Johnson, Visa, hundreds more. Each of those companies is traded millions of times per day. Each trade is an individual investor or institution making a judgment. This stock is worth buying at this price, or worth selling at this price. Let's focus on just one. Apple. Currently valued at about $3.5 trillion. Apple is the largest company in the world by market capitalization. Every trading day, about 50-60 million Apple shares change hands at roughly $230 per share. That's about $13 billion in Apple stock trading every single day. Why are people buying and selling $13 billion of Apple stock daily? Because new information is constantly arriving. iPhone sales data, regulatory news, macroeconomic indicators, competitor developments, Federal Reserve announcements, currency movements, geopolitical events. Every piece of information gets processed instantly. If iPhone sales in China look weak, the stock drops immediately. If a new product announcement exceeds expectations, it rises. If the dollar strengthens, making foreign revenue worth less, it adjusts. Multiply this by 500 companies and you get the S&P 500. Multiply by all publicly traded U.S. companies and you get the total U.S. market. Multiply by all global markets and you get a real-time economic scoreboard processing information 24 hours a day across every time zone in every major economy. This is why professional economists pay obsessive attention to stock markets. Not because they care about investor returns, but because markets are leading indicators. They move before economic data confirms what's happening. When the stock market crashes, a recession often follows within 6-18 months. Not always there have been false signals, but often enough that the stock market is called a leading indicator of economic activity. Why does it lead? Because investors are forward-looking. They don't care about today's GDP. They care about next quarter's earnings, which depend on next quarter's economic conditions. When investors collectively start selling, it means they see trouble ahead. Slowing growth, rising unemployment, falling corporate profits. They're not reacting to current conditions, they are anticipating future conditions. Sometimes they are wrong. In 1987, the stock market crashed 22% in a single-day Black Monday, and yet no recession followed. It was a false signal, driven by portfolio insurance strategies and technical factors rather than fundamental economic problems. But more often, they are right. In 2007, the stock market peaked in October and began falling. Economists insisted the economy was fine. The recession wasn't officially declared until December 2007, and most people didn't realize we were in recession until 2008. But the stock market saw it coming months earlier. Your $45,000 retirement account is connected to all of this. When it drops, it's not just bad luck. It's the collective intelligence of global markets signaling something about future economic health. Now let's talk about scale. Your $45,000 is real money to you. Your coworker's $180,000 is significant wealth. But let's put this in context. The median American household has a net worth of about $192,000. Most of that is home equity. The median retirement account balance for Americans aged 55-64 is about $185,000. So if you're in your 30s or 40s with $45,000 saved, you're actually doing reasonably well compared to most people. But compared to what's moving through markets daily, these numbers are infinitesimal. The New York Stock Exchange alone processes about $50-80 billion in trading volume every single day. That's the total dollar value of stocks changing hands. The Nasdaq processes another $50-70 billion. Combined, U.S. stock exchanges see roughly $100-150 billion in daily trading volume. Every day, day after day, about $25-35 trillion per year in stock trades. Your $45,000 retirement account, if you never touched it, would be traded 0 times. Your buy and hold. But if you were an active trader, your $45,000 would be a rounding error in the daily $150 billion. To put it another way, the total value of stocks traded in one day exceeds the GDP of all but about 15 countries on Earth. More money changes hands in the US stock market in a single day than Vietnam or Bangladesh produces in an entire year. And that's just stocks. Add in bonds, currencies, commodities, derivatives, and the daily trading volume across all financial markets globally is approximately $6-7 trillion per day. Let that number settle for a moment. $6 to $7 trillion every single day. That's roughly $1.5-1.8 quadrillion per year in financial market transactions. For comparison, global GDP is about $105 trillion per year. Financial markets trade roughly 15 times global GDP annually. Money circulates through markets at a velocity that dwarfs actual economic production. Why? Because the same assets trade over and over. Apple stock doesn't just trade once. It trades 50 million times per day. Treasury bonds don't just trade once. They trade trillions of dollars worth per day in the repo market. This velocity is itself informative. High trading volume means lots of information processing, lots of disagreement about value, lots of position changes as new data arrives. Low volume means consensus, clarity, people holding their positions because they are confident in their assessment. When markets are healthy, volume is steady and predictable. When markets are stressed, volume spikes as everyone tries to adjust positions simultaneously. During the March 2020 crash, daily volume hit $500 billion, more than triple the normal rate. Everyone was selling at once, trying to get out before things got worse. That volume spike was a signal. Panic. Not just price declines, but panic-driven selling. A rush for the exits. This kind of volume tells market observers something important. Investor psychology has shifted from rational analysis to fear-driven reaction. Economists and policymakers watch this closely. Not because they care about investor profits, but because panic-driven selling can become self-fulfilling. If everyone sells because they're scared, prices fall, which scares more people who sell, causing more declines in a doom loop. This is why central banks intervene. The Federal Reserve in March 2020 didn't just cut interest rates. They announced unlimited quantitative easing, unlimited bond purchases, whatever it takes to stop the panic. And it worked. Volume normalized, prices stabilized, the panic subsided, not because the economic situation had improved, unemployment was still rising, but because the Fed's intervention broke the psychological spiral. This is the stock market as a macro health indicator. It's not just measuring economic fundamentals. It's measuring psychology, confidence, fear, expectations, and the willingness of investors to take risk. All of these are crucial components of economic health. An economy needs confidence to function. Businesses won't invest if they're terrified of the future. Consumers won't spend if they expect to lose their jobs. Banks won't lend if they fear defaults. The stock market aggregates all of this sentiment into a single number, the price. When prices are rising steadily, it signals confidence. When they are volatile, it signals uncertainty. When they are crashing, it signals fear. And these psychological states drive real economic behavior. A CEO looking at a 20% stock market decline doesn't just see lower paper wealth. They see potential recession. They delay expansion plans. They freeze hiring. They cut costs. Their caution becomes the recession they feared. This is why stock market crashes often precede recession. Not because the market has mystical forecasting powers, but because the psychology captured in market prices drives the behavior that creates the recession. Your $45,000 retirement account is a tiny piece of this massive system. But the system's health affects you directly. When markets crash and trigger recessions, your job becomes less secure. Your wage growth slows. Your hours might be cut. Your company might lay people off. The stock market doesn't just predict the economy. In a very real sense, it partly creates the economy through the expectations and behaviors it generates. No, most people with retirement accounts don't think about any of this. They check their balance, feel good or bad depending on the number, and move on with their day. They are passive participants in a system they don't fully understand. But the system is always working, always processing information, always adjusting prices based on new data about the current and future state of the economy. And those price adjustments contain remarkably accurate information if you know how to read them. Think about what happens when unemployment data is released. The Bureau of Labor Statistics announces monthly jobs numbers every first Friday. Let's say unemployment unexpectedly rises from 3.8% to 4.2%. Within milliseconds, literally milliseconds, the stock market reacts. Algorithmic trading systems parse the data release, determine it's worse than expected, and begin selling. Within seconds, the S&P 500 might drop 1-2%. Why? Because higher unemployment suggests economic weakness. Weaker economy means lower corporate earnings. Lower earnings means stocks are worth less. The entire chain of logic plays out in seconds. But here's what's fascinating. The market often gets there first. Sometimes stock prices start declining before official unemployment data confirms weakness. Why? Because other indicators show up first. Weekly initial unemployment claims provide early signals. Corporate layoff announcements, declining temporary worker hiring, job posting reductions. These leading indicators appear in market prices before they show up in official statistics. This is the market as an information aggregator. It's processing thousands of data points, some official, some anecdotal, some from company earnings calls, some from economic reports, and synthesizing them into a single price. That price reflects the collective judgment of millions of participants, each with their own information sources and analytical frameworks. No single person has all the information, but the market price aggregates all of it. This is called the efficient market hypothesis in its strong form. Markets quickly incorporate all available information into prices. Whether this is perfectly true is debatable. There are definitely market inefficiencies and behavioral biases. But it's true enough that market prices are remarkably informative about economic conditions. When the yield curve inverts when short-term interest rates exceed long-term rates, it's one of the most reliable recession predictors we have. Why? Because it means bond investors expect the Federal Reserve to cut rates in the future, which usually only happens during recessions. The yield curve inverted in 2006, predicting the 2008 recession. It inverted in 2019, predicting, well, COVID complicated that one. It inverted again in 2022, and as of late 2023, recession predictions were intensifying. This isn't magic. It's information processing. Bond investors see economic data, corporate earnings trends, Federal Reserve policy, consumer behavior, and they make predictions about the future path of interest rates. Those predictions get embedded in bond prices, which determine the yield curve. Stock markets do the same thing, but across a broader set of variables. Not just interest rates, but earnings growths, inflation expectations, currency movements, geopolitical risks, technological disruption, regulatory changes, demographic trends, and hundreds of other factors. All of this gets processed continuously, 24/7, across global markets, and synthesized into stock prices that move every fraction of a second. Your $45,000 retirement account rides on top of this information processing system. You're benefiting from it even if you don't understand it. When you buy an index fund, you're essentially saying, I trust that market prices reflect reasonable assessments of value, so I'll just own everything and let the market's collective intelligence work for me. And historically, that's worked. Despite crashes, recessions, wars, pandemics, and crises, the S&P 500 has returned about 10% annually over the long term. That's the market's information processing creating value over time as the economy grows and companies become more profitable. But here's the thing. Those returns aren't smooth, and the path from $45,000 to your retirement goal isn't a straight line. It's a roller coaster driven by macroeconomic forces that show up in stock prices long before they show up anywhere else. This brings us to something crucial. Stock markets don't just reveal macro health. They influence it. They are not passive observers. They are active participants in economic feedback loops. When stock prices rise, people feel wealthier. This is called the wealth effect. You check your retirement account, see it's grown to $50,000 from $45,000, and you feel a bit more secure. Maybe you splurge on a vacation. Maybe you upgrade your car. Maybe you just worry less about money. Multiply this across millions of people, and rising stock markets boost consumer spending. Higher spending drives economic growth. Higher growth drives corporate earnings. Higher earnings justify higher stock prices. The cycle reinforces itself. The reverse is also true. Falling stock markets make people feel poorer, even if they haven't actually sold anything. They cut spending. They delay purchases. They increase savings out of fear. Lower spending slows the economy. Slower economy means lower earnings. Lower earnings justify lower stock prices. The doom loop. This feedback mechanism is why central banks pay such close attention to stock markets. Not because they want to prop up investor wealth, but because stock market crashes can trigger recessions through the wealth effect and the confidence channel. The Fed doesn't have an explicit stock market target, but they are acutely aware that a 20-30% market crash could derail the economy regardless of underlying fundamentals. So they intervene when necessary to prevent panic and maintain confidence. This creates moral hazard. The Fed put the belief that the Fed will always save markets from major crashes. It encourages excessive risk-taking because investors believe they are protected from catastrophic losses. But it also creates stability. By preventing panic-driven crashes, the Fed prevents the feedback loops that turn market corrections into economic disasters. This is the delicate balance central banks must maintain. Allow markets to reflect economic reality while preventing destructive spirals. Your $45,000 retirement account exists within this system, protected by central bank interventions when things get really bad, subject to volatility when uncertainty is high, growing over time as the economy expands and companies become more valuable. But to truly understand what stock markets reveal about macro health, we need to go much deeper. Beyond your personal account, beyond simple price movements, into the structure of the market itself, the sectors that lead and lag, the international connections, the derivative markets, and the subtle signals that separate noise from genuine macroeconomic information. Because your $45,000 is just the beginning. the starting point for a journey that will show you how stock markets function as the economic nervous system of modern capitalism, processing information faster than any other system, revealing truths before official data confirms them, and influencing the very economic reality they are supposed to reflect. We're about to climb the ladder. From personal portfolios to market sectors, from sectors to international markets, from international markets to derivatives and leverage, from derivatives to the actual information content embedded in every price movement. Each step will make the previous one look microscopic. Each level will reveal new dimensions of how markets process economic information and signal macroeconomic health. And by the end, you'll never look at your retirement account balance the same way again. Let's talk about something most retail investors never consider. The stock market isn't one thing. It's 11 different sectors, each responding to different economic forces, each revealing different information about macro health. Your $45,000 S&P 500 index fund automatically weights these sectors by their market capitalization. Currently, that means roughly 28% in information technology, 13% in healthcare, 13% in financials, 11% in consumer discretionary, 8% in communication services, and the rest spread across industrial, consumer staples, energy, utilities, real estate, and materials. These aren't arbitrary categories. They're economic divisions that respond differently to growth, inflation, interest rates, and economic cycles. And professional investors watch sector rotation, money moving between sectors, as one of the clearest signals of changing macroeconomic conditions. Here's how it works. When the economy is emerging from recession and starting to recover, certain sectors lead. Financials typically rise first because banks benefit from improving loan quality and increasing lending as businesses regain confidence. Consumer discretionary stocks rise because people start spending on non-essentials again. Technology stocks often surge as businesses invest in productivity-enhancing tools. This is the early cycle phase. The economy is growing but still has slack. Unemployment is elevated but falling. Inflation is low. Interest rates are low. This environment is great for growth stocks companies that are expected to grow earnings rapidly regardless of the broader economy. You can see this in the data. After the 2008 recession ended in June 2009, financials were the best performing sector for the next year, rising 130%. Consumer discretionary rose 85%. Technology rose 75%. These weren't coincidences. They were sectors responding to early cycle economic conditions. Then, as recovery progresses into mid-cycle expansion, the leadership shifts. Industrials and materials become the best performers as business investment accelerates and commodity demand rises. These are cyclical sectors. They do well when the economy is growing strongly. During mid-cycle, the economy is at or near full employment. GDP growth is strong. Corporate earnings are robust. But inflation is starting to creep up as the economy heats up. Interest rates begin rising as the Federal Reserve taps the brakes to prevent overheating. You can see this pattern in 2017-2018. The economy was in a strong mid-cycle expansion. Industrials rose 28% in 2017. Materials rose 24%. Energy surged 35% as oil prices recovered. These sectors were signaling robust economic health and strong commodity demand. Late in the cycle, as the economy approaches peak growth and recession, risks rise. Defensive sectors take over. Utilities, consumer staples, and healthcare, these are sectors that do well regardless of economic conditions because people always need electricity, food, and medicine. When money starts rotating into defensive sectors, it's a warning sign. It means investors are getting nervous. They are reducing exposure to economically sensitive sectors and moving to safety. They expect growth to slow or possibly contract. This happened in late 2007, while most investors were still celebrating what seemed like a healthy economy. Sector rotation told a different story. Utilities were outperforming. Consumer staples were holding up while consumer discretionary weakened. Financials were starting to crack. Professional investors watching sector rotation saw recession coming before it was officially declared. The information was embedded in relative sector performance. Money was moving defensively, signaling fear about the economic outlook. The same pattern appeared in 2019. As the economy slowed and trade war tensions escalated, utilities became the best performing sector. Real estate investment trust rates surged as investors sought dividend income. Defensive rotation was underway. Then COVID hit, scrambling all normal patterns. But even during COVID, sector rotation revealed crucial information. After the March 2020 crash, technology surged while energy collapsed. Why? Because investors correctly anticipated a future with more remote work, e-commerce, and cloud computing benefiting tech and less transportation, less oil demand, potentially permanent demand destruction for fossil fuels. The sector rotation predicted the next 2 years of economic reality. Now, you might be thinking, this is interesting, but how does it help me understand macro health? Here's the key insight. Sector rotation happens before economic data confirms what's happening. Investors don't wait for the National Bureau of Economic Research to officially declare a recession. They see it coming in corporate earnings guidance, manufacturing data, consumer confidence, credit conditions, and they rotate their portfolios accordingly. This makes sector rotation a leading indicator. It moves before the economy turns. Let's get specific with some numbers. The typical economic cycle lasts 5-7 years from recession to recession. During that time, sector leadership follows a predictable pattern that reveals where the economy is in the cycle. Early cycle first 1-2 years after recession. Financials plus 45%, consumer discretionary plus 40%, technology plus 38% average annual returns. Mid-cycle years 3-4, industrials plus 25%, materials plus 22%, energy plus 20% average annual returns. Late cycle years 5-6, utilities plus 15%, consumer staples plus 12%, healthcare plus 11% average annual returns. These aren't random. They reflect how different businesses perform under different macroeconomic conditions. And when you see rotation accelerating when money floods into late cycle sectors while dumping cyclical sectors, it's time to pay attention. In 2006, this rotation was screaming recession. Utilities gained 20% while financials dropped 11%. Consumer staples rose while consumer discretionary stagnated. The rotation was telling anyone watching, the economy is about to turn. Most people missed it. They focused on headline indices. The S&P 500 was still near all-time highs in October 2007. But underneath, sector rotation had been warning for over a year that trouble was coming. This is where market cap weighting matters. The S&P 500 can keep rising even as most sectors weaken, if the largest stocks currently dominated by megacap technology keep going up. In early 2000, the S&P 500 hit new highs driven by technology stocks that represented 35% of the index. But underneath, 7 of 11 sectors were already in bear markets. Small-cap stocks had peaked in 1998. International markets had peaked in 1999. The rot was spreading, but headline indices masked it. This is why professional investors use equal weight indices alongside cap-weighted indices. An equal weight S&P 500 gives each stock the same weight regardless of size. When equal weight underperforms cap weight, it means a few large stocks are driving the market while most stocks are weak. This divergence is a warning sign. It suggests narrow leadership, which typically occurs late in bull markets when investors are desperately chasing the few stocks still working while everything else deteriorates. This pattern appeared in 2021-2022. The S&P 500 kept hitting new highs, but the equal weight version lagged significantly. Only a handful of mega-cap technology stocks were driving gains, while the median stock was actually down. This told informed observers, breadth is weak. Market internals are deteriorating. This looks like late-cycle dynamics, even if headline indices don't show it yet. And they were right. By 2022, the market entered a bear market as those mega-cap leaders finally cracked under the weight of rising interest rates and slowing growth expectations. Now let's talk about international markets, because they add another dimension to understanding macro health. U.S. markets represent about 60% of global stock market capitalization, roughly $50 trillion out of $85 trillion worldwide. Europe accounts for about $20 trillion, Japan $6 trillion, China $11 trillion, and emerging markets combined about $8 trillion. These markets don't move in lockstep. Sometimes they correlate highly during global crises like 2008 or COVID. Everything crashes together. But during normal times, they diverge based on local economic conditions, currency movements, regulatory environments, and political situations. These divergences contain information. When U.S. markets are strong but European markets are weak, it tells you something about relative economic health. Maybe Europe is dealing with an energy crisis while the U.S. is energy independent. Maybe the European Central Bank is tightening faster than the Federal Reserve. Maybe European economies are more exposed to a particular geopolitical risk. In 2022, this pattern was stark. U.S. markets fell about 18%, painful but manageable. European markets fell 12% in local currency terms, but the euro fell 10% against the dollar, meaning European markets were down over 20% from a U.S. investor's perspective. Why? Europe was much more exposed to the Russia-Ukraine war and the resulting energy shock. Natural gas prices in Europe went up 10x. Electricity became absurdly expensive. Industrial production faced constraints. The macro outlook was much worse than in the U.S. European stock market underperformance signaled this reality before GDP data confirmed it. By watching relative market performance, investors could see that Europe was heading for recession while the U.S. might avoid one. The same applies to emerging markets. When EM stocks outperform, it often signals a global growth acceleration and commodity demand recovery. Emerging markets are heavily exposed to commodity production and commodity-driven growth, so they do well when global growth is accelerating. From 2003-2007, emerging markets dramatically outperformed developed markets. The MSCI Emerging Markets Index rose about 350%, while the S&P 500 rose about 80%. This wasn't random luck. It was signaling the Chinese-led global growth boom, rapid industrialization, massive commodity demand, and a multi-year economic expansion. Conversely, when EM underperforms, it signals global growth concerns. In 2013-2015, EM stocks went nowhere while U.S. stocks rose 40%. This preceded the global growth slowdown of 2015-2016, driven by Chinese economic deceleration and falling commodity prices. Currency markets add another layer. When the dollar strengthens significantly, it often signals global risk-off sentiment investors fleeing to safety. A strong dollar makes it harder for emerging markets to service dollar-denominated debt, creates financial stress, and can trigger crises. The dollar tends to strengthen during U.S. recessions or global crises. It strengthened massively in 2008 during the financial crisis, again in 2020 during COVID, again in 2022 as the Fed hiked rates aggressively while other central banks lagged. Each time, dollar strength signaled increasing global financial stress and deteriorating macro conditions outside the U.S. Stock markets embed all of this information. Relative performance of sectors, countries, market cap segments, and currencies creates a multidimensional picture of global macroeconomic health. But to really understand what markets are revealing, we need to talk about the information content in specific market indicators that professional macro investors watch obsessively. The high-yield bond spread. This measures the difference between yields on junk bonds, low-quality corporate debt, and safe treasury bonds. When the spread is narrow, say 3-4 percentage points, it means investors are comfortable taking risk. They're not worried about defaults. The economy feels healthy. When the spread widens to 8-10 percentage points or more, it means investors are scared. They're demanding much higher yields to compensate for default risk. They expect economic trouble ahead that will cause some companies to fail. The high-yield spread widened dramatically in late 2007 and early 2008, long before the recession became obvious to most people. It widened from about 3% to over 10%, signaling that bond investors saw serious trouble coming. They were right. Defaults surged in 2008-2009 as the recession deepened. But the signal came early, embedded in the bond spread, visible to anyone watching. The same indicator spiked in March 2020 COVID, in 2015-2016 global growth scare, and in late 2011 European debt crisis. Each time, widening spreads preceded or coincided with economic weakness. Stock markets watch this closely. When high-yield spreads widen, stocks usually fall because widening spreads signal deteriorating credit conditions and economic weakness ahead. The copper-to-gold ratio. This is a favorite of macro investors. Copper is an industrial metal used in construction, manufacturing, and electronics. It's called Dr. Copper because it has a PhD in economics. It predicts economic turning points. Gold is a safe haven asset. People buy it when they're worried about the economy or inflation. The ratio of copper prices to gold prices, therefore, measures economic optimism versus fear. When copper is rising relative to gold, it signals economic growth expectations. Industrial demand is strong. Investors are optimistic. When gold is rising relative to copper, it signals economic fear. Industrial demand is weak or expected to weaken. Investors are fleeing to safety. This ratio has predicted many economic turns. It peaked in early 2008 and then collapsed as the recession approached. It bottomed in early 2009 and then surged as recovery began. It weakened in 2015-2016 during the global growth scare and recovered in 2017-2018 as growth accelerated. Stock markets strongly correlate with this ratio. When copper outperforms gold, stocks usually rise. When gold outperforms copper, stocks usually fall. The ratio is embedding information about future economic conditions that shows up in both commodity and equity prices. The volatility risk premium. This is more technical but crucial for understanding market psychology. Options traders sell volatility. They sell insurance against market swings and collect premiums. The premium they collect represents how much fear exists in the market. High premiums mean investors are scared and willing to pay a lot for protection. Low premiums mean complacency. When the volatility risk premium collapses when realized volatility exceeds implied volatility, it signals something broke. The models failed. The assumptions were wrong. Reality exceeded expectations. This happened in February 2018 when the VIX spiked from 10 to 40 in a single day. It happened in March 2020 when the VIX went from 14 to 82. In both cases, the collapse of the volatility risk premium signaled that market complacency had ended and uncertainty was spiking. These events usually coincide with economic deterioration or crisis. The spike itself can cause problems through forced deleveraging and risk parity fund rebalancing, but the underlying cause is typically a macro shock that markets weren't pricing properly. Earnings revisions. This is perhaps the most direct link between stock markets and macro health. Every quarter, analysts who cover stocks publish earnings estimates. These estimates represent their expectations for corporate profitability based on their understanding of economic conditions, company-specific factors, and industry trends. When economic conditions are improving, analysts revise their estimates upward. Companies beat estimates and raise guidance. Analysts increase their forecasts. This creates a positive feedback loop where rising estimates justify higher stock prices. When economic conditions deteriorate, the opposite happens. Companies miss estimates and lower guidance. Analysts cut their forecasts. Downward revisions accelerate. Stock prices fall to reflect lower expected earnings. The aggregate earnings revision trend, whether analysts are collectively raising or lowering estimates, is a powerful macro indicator. In early 2008, earnings revisions turned negative. Analysts who had been expecting 10-15% earnings growth started cutting to 5%, then 0%, then negative. This revision process took months, but it clearly signaled deteriorating business conditions long before the recession was officially declared. Stock markets fell as revisions turned negative because lower expected earnings mean lower stock valuations. The market was incorporating macro weakness through the earnings channel, visible to anyone tracking revision trends. The same pattern appears at every economic turning point. Revisions turn positive early in recoveries and negative late in expansions. They lead the business cycle by several months, providing early warning of changing conditions. Forward P/E ratio expansion and contraction. This gets at market valuation and how it reflects macro expectations. The price-to-earnings ratio compares stock prices to corporate earnings. A forward P/E uses expected future earnings instead of past earnings. Currently, the S&P 500 trades at about 19-20x forward earnings, meaning investors are paying $19-20 for every dollar of expected next year earnings. This ratio isn't constant. It expands and contracts based on multiple factors: interest rates, growth expectations, risk appetite, and macro uncertainty. When interest rates are low, P/E ratios can sustain higher levels because the discount rate for future earnings is lower. In the 2010, with near zero rates, the S&P 500 traded between 16-20x earnings above historical averages. When rates rise, P/E ratios typically compress. In 2022, as the Fed hiked rates from 0% to 5%, the S&P 500's P/E contracted from about 21x to 16x, even as earnings remained relatively stable. The multiple compression stocks getting cheaper relative to earnings was driven by higher interest rates, making future earnings less valuable in present terms. But P/E ratios also reflect growth expectations. When investors expect strong future growth, they're willing to pay higher multiples. When they expect slow growth or recession, they demand lower multiples. In 2000, the S&P 500 traded at 28x forward earnings, absurdly high. Investors were willing to pay that much because they expected internet-driven productivity growth to generate enormous earnings increases. They were wrong. Earnings didn't materialize. The multiple collapsed, and stocks fell 50%. The lesson: extreme P/E ratios signal extreme expectations about future macro conditions. Very high multiples signal excessive optimism and often precede disappointments. Very low multiples signal excessive pessimism and often precede recoveries. In March 2009, the S&P 500 traded at about 12x forward earnings cheap by historical standards. Investors were terrified, expecting depression-level outcomes. But the economy recovered, earnings grew, and stocks quintupled over the next decade. The P/E ratio embedded macro expectations that turned out to be too pessimistic. Recognizing this misalignment was the key to understanding that stocks were cheap relative to likely economic outcomes. Now here's where it gets really interesting. Different market segments trade at different P/E ratios based on their sensitivity to macro conditions. Cyclical stocks, those highly sensitive to economic growth, like industrials and materials, trade at lower P/E ratios because their earnings are volatile. Defensive stocks, those stable regardless of the economy, like utilities, trade at higher P/E ratios because their earnings are reliable. When the spread between cyclical and defensive P/E ratios narrows, it often signals that investors are becoming more confident about economic growth. They're willing to pay more for cyclical earnings because they expect those earnings to be sustained. When the spread widens, it signals growing macro concerns. Investors discount cyclical earnings more heavily because they expect economic weakness ahead. This spread is another macro health indicator embedded in market pricing. Let me give you a concrete example of how all this comes together. In August 2007, most economic data looked fine. GDP was growing 2-3%. Unemployment was 4.7%, close to full employment. Corporate earnings were strong. The Fed had stopped raising rates. But stock markets were signaling trouble. Financials had peaked in February 2007 and were down 15% by August. The high-yield bond spread was widening. Homebuilder stocks had collapsed down 50% or more. Mortgage rates were imploding. Sector rotation was underway, money flowing into utilities and staples, out of financials and discretionary. Earnings revisions for financials were turning negative. The copper-gold ratio was weakening. All of these signals were screaming, something is wrong in the economy, specifically in housing and credit markets. The recession wasn't officially declared until December 2007, 4 months later. But stock markets saw it coming much earlier by aggregating information from housing data, credit market stress, sector weakness, and changing investor positioning. This is the power of markets as macro indicators. They don't wait for official confirmation. They process available information in real time and embed it in prices that any observer can see. Your $45,000 retirement account was part of this. If you held an S&P 500 index fund in August 2007, you were down slightly from the February peak, even though you probably didn't notice. But the underperformance of financials within your fund was signaling macro trouble ahead. By October 2007, the S&P 500 hit what would be its pre-crisis peak, 1,565. By March 2009, it bottomed at 676, down 57%. Your $45,000 would have become $19,350. Devastating. But the signals were there early for anyone watching sector rotation. Credit spreads, earnings revisions, and market internals. This isn't hindsight bias. Professional investors who watched these indicators raised cash, reduced risk, and avoided the worst of the crash. Not because they are smarter, but because they understood what markets were revealing about deteriorating macro health. The same patterns appear at every major turning point. Markets lead the economy. They process information faster than official statistics. They reveal macro health through sector rotation, relative performance, credit spreads, volatility, earnings revisions, and valuation changes. Understanding these signals doesn't mean you'll perfectly time every market move, but it means you'll have a much clearer picture of where the economy is heading and what risks are building beneath the surface. And that knowledge is valuable. Far more valuable than just checking your account balance once a month and hoping for the best. Now we need to talk about something that transforms how we understand stock markets as macro indicators: leverage and derivatives. Because the stock market, you see the prices on your screen, the balances in your account sits on top of a much larger structure of borrowed money and financial contracts. The total value of the U.S. stock market is about $50 trillion. But the notional value of all derivatives contracts globally is approximately $600 trillion. Let that sink in for a moment. Derivatives markets are 12 times larger than all global stock markets combined. They are 6 times larger than global GDP. These derivatives aren't separate from stock markets. They are intimately connected. Options on stocks, futures on indices, swaps tied to equity returns, structured products that package stock market exposure with leverage and customized risk profiles. And all of this leverage amplifies both gains and losses, creating feedback loops that affect the underlying stocks themselves. Here's how it works in practice. Let's start simple. Margin debt is the most straightforward form of stock market leverage. Investors borrow money from their brokers to buy more stocks than they could afford with cash alone. Currently, margin debt in the U.S. stands at about $700-800 billion. That means investors have borrowed $750 billion to amplify their stock market exposure. When markets rise, this leverage magnifies gains. A 10% market rise becomes a 20% gain for someone using 50% margin. But when markets fall, leverage magnifies losses. And more dangerously, it creates forced selling. If you bought $100,000 worth of stocks with $50,000 of your money and $50,000 borrowed, and the stocks fall 20%, you now have $80,000 in stock value, but still owe $50,000. Your equity has dropped from $50,000 to $30,000, a 40% loss. Double the market's decline. If the market falls much more, your broker will issue a margin call. Either deposit more money or will sell your stocks to repay the loan. Most people can't deposit more money during a crash, so they are forced to sell. That selling pushes prices lower, triggering more margin calls, creating a cascade. This happened in 2008. Margin debt peaked at $381 billion in July 2007. As markets fell, investors faced margin calls. Forced selling accelerated the decline. By March 2009, margin debt had collapsed to $175 billion as half the leverage was wiped out. The deleveraging itself amplified the crash. Stock prices fell not just because of deteriorating fundamentals, but because leveraged investors were forced to sell regardless of value. This creates information about macro health in 2 ways. First, rapidly rising margin debt signals, excessive speculation and complacency. Investors are so confident they're borrowing to increase exposure. This often happens late in bull markets before major crashes. Second, rapidly falling margin debt signals force deleveraging and panic, a negative feedback loop that typically accompanies recessions. Currently, margin debt has been declining from its 2021 peak of $935 billion. This deleveraging suggests reduced speculation and potentially precautionary behavior by investors concerned about macro conditions. But margin debt is just the beginning. Derivatives create far more complex leverage. Options markets have exploded in size. Daily options volume now regularly exceeds 40-50 million contracts on U.S. stocks and indices. Each contract represents 100 shares of underlying stock, meaning options volume represents exposure to 4-5 billion shares daily. For context, the average daily trading volume in the actual stock market is about 10-12 billion shares. Options volume represents 40-50% of actual stock volume, an enormous tail wagging the dog. This matters because options aren't neutral. Market makers who sell options hedge their exposure by buying or selling the underlying stocks. This hedging creates mechanical buying and selling pressure that moves stock prices. When a surge of call option buying occurs, investors betting on rising prices, market makers must buy stocks to hedge. This buying pushes prices higher, which makes more call buying profitable, creating more hedging demand in a feedback loop. This gamma squeeze dynamic drove much of the retail trading frenzy in 2020-2021. Stocks like GameStop and AMC saw massive call option buying by retail investors, forcing market makers to buy enormous quantities of stock to hedge, driving prices to absurd levels far exceeding any fundamental value. The same dynamic works in reverse. When investors buy put options betting on falling prices, market makers must sell stocks to hedge. This selling pressure accelerates declines, potentially triggering more put buying and more hedging sales. This happened in February 2018 when the stock market had its Volmageddon flash crash. A surge of volatility triggered systematic selling by vol-targeting funds and put option hedging, which amplified price declines, which triggered more systematic selling, creating a one-day 4% crash. The important point: stock prices aren't just reflecting fundamental information about macro health. They're also reflecting derivatives-driven flows, systematic strategies, and leverage dynamics that create their own price movements independent of economics. This makes reading market signals more complex. Is a price decline signaling economic deterioration or just forced deleveraging? Is a rally driven by improving fundamentals or options-related hedging flows? Professional macro analysts have to disentangle these effects to extract the true economic signal from market noise. Now let's add another layer: international capital flows. Stock markets are global and interconnected. When U.S. markets fall significantly, foreign markets typically follow within hours. When China's markets crash, U.S. markets often gap down at the open. When European markets surge, U.S. futures rise overnight. This correlation isn't perfect, but it's strong, especially during crisis periods. In 2008, virtually all global markets fell together: U.S. down 57%, Europe down 55%, Japan down 60%, emerging markets down 65%. Why do markets correlate globally? Because macro shocks are often global. Financial crises spread through interconnected banking systems. Recessions in large economies reduce global trade. Commodity price shocks affect all importers and exporters. But the mechanics of correlation matter. When markets correlate due to shared fundamental shocks, a global pandemic, a financial crisis, a commodity price spike, the correlation is informative about true macro stress. When markets correlate due to technical factors, cross-border capital flows, hedge fund deleveraging, currency hedging, the correlation may be less informative about underlying economic conditions. Here's a specific example. In August 2015, Chinese stocks crashed, falling 30% in 2 weeks. This triggered a global sell-off. U.S. Markets fell 11%. European markets fell 15%. Emerging markets collapsed 18%. Was this correlation informative about global macro health? Partially. China's slowdown was real and affected global growth, but the intensity of the sell-off was amplified by technical factors: currency hedging, risk parity fund deleveraging, algorithmic selling triggers. By September 2015, U.S. markets had recovered most of the loss. The Chinese contagion proved less severe than the initial panic suggested. The market overreacted to the downside due to leverage and technical selling, then corrected back toward fundamentals. Understanding this dynamic is crucial for reading macro signals from markets. You have to separate genuine economic deterioration from technical volatility amplified by derivatives and leverage. Currency markets add another dimension. When stock markets fall globally, the dollar typically strengthens as investors flee to safety. But currency movements themselves affect stock valuations and corporate earnings. For U.S. companies that generate significant foreign revenue, a strong dollar is negative. Their foreign earnings are worth less when converted to dollars. About 40% of S&P 500 revenue comes from abroad, making dollar strength a meaningful headwind to earnings. In 2015, the dollar surged 20% in a year. This killed S&P 500 earnings growth. Companies reported flat to negative earnings, largely due to currency translation effects. Stock markets struggled despite a decent U.S. economy because dollar strength was crushing earnings. This is macro health information embedded in currency and stock price interaction. A surging dollar often signals relative U.S. economic strength or global risk aversion. Either way, it has real effects on corporate profitability that show up in stock prices. Conversely, a weakening dollar is often associated with global growth acceleration, and commodity price rises both positive for corporate earnings and stock prices. From 2002 to 2007, the dollar fell steadily while stock markets globally surged. From 2009 to 2012, dollar weakness accompanied the post-crisis recovery. The correlation isn't perfect, but the pattern is clear. Dollar strength creates headwinds. Dollar weakness creates tailwinds. Now let's talk about what happens when everything breaks at once. Financial crises are moments when all the interconnections, leverage, and derivatives simultaneously unwind. Markets don't just fall, they dislocate. Correlations go to 1.0 as everything crashes together. Liquidity evaporates. Normal market functioning breaks down. In these moments, stock markets reveal the ultimate truth about macro health. The financial system is fragile. September 2008 is the canonical example. Lehman Brothers filed for bankruptcy on September 15. Within days, money market funds broke the buck, fell below $1 per share value. Commercial paper markets froze. Interbank lending stopped. Credit markets seized up completely. Stock markets crashed 25% in 2 weeks. But the crash wasn't just reflecting economic weakness. It was reflecting systemic financial fragility, the realization that major financial institutions were insolvent, that counterparty risk was everywhere, that the entire system could collapse. The message from markets was clear and terrifying. We're facing potential financial system collapse and economic depression. This forced unprecedented intervention. The Federal Reserve, Treasury, FDIC, and Congress implemented massive programs: TARP bank bailouts, Fed asset purchases, deposit insurance expansion, interest rate cuts to zero, currency swap lines with foreign central banks. The intervention worked. Markets stabilized. The financial system survived. But stock prices had revealed the fragility before policymakers fully grasped it. The same pattern appeared in March 2020. COVID triggered not just a stock market crash, but a broader financial market seizure. Treasury markets, supposedly the safest, most liquid market in the world, experienced severe dysfunction. Corporate bond markets froze. Even money market funds faced stress. Stock prices falling 34% in 5 weeks revealed both the economic shock of lockdowns and the financial fragility of a highly leveraged system built on continuous liquidity. Again, intervention was necessary. The Fed's response in March 2020 was even larger than 2008. Unlimited QE, corporate bond purchases, municipal bond support, Main Street lending programs. Markets revealed the problem, and policy responded to fix it. This reveals something profound about what stock markets show us about macro health. They don't just reflect economic fundamentals. They reveal systemic fragility, leverage accumulation, liquidity conditions, and the adequacy of policy responses. When markets are calmly rising, it signals not just good economic conditions, but also healthy financial plumbing, adequate liquidity, and appropriate policy stance. When markets are crashing with signs of systemic stress, credit spreads blowing out, volatility spiking, correlations going to 1.0, liquidity disappearing, they're revealing that something is deeply wrong beyond just economic weakness. Understanding the difference is crucial. A normal bear market driven by slowing growth is very different from a financial crisis driven by systemic fragility. The 2022 bear market was the former. Markets fell 25% as the Fed hiked rates and growth slowed, but financial markets functioned normally. No liquidity crisis, no systemic stress, just repricing for higher rates and lower growth expectations. This told macro observers, recession risk is elevated, but systemic risk is low. Different from 2008 or 2020, where systemic risk dominated. Now let's talk about flows, the actual movement of money into and out of markets. Monthly flows into and out of equity mutual funds and ETFs reveal investor sentiment and positioning. When retail investors are piling money into stock funds, it often signals late-cycle FOMO, fear of missing out, and excessive optimism. In 2021, equity fund inflows hit record levels. Over $900 billion flowed into stock funds in a single year, more than the previous 10 years combined. This extreme optimism and positioning preceded the 2022 bear market. Conversely, extreme outflows often mark market bottoms. In Q4 2008 and Q1 2009, investors pulled hundreds of billions from stock funds right at the market bottom, selling at the worst possible time due to panic. Flow data reveals investor psychology in real time. When flows are extreme in either direction, it often signals a turning point is near because sentiment has reached an unsustainable extreme. Corporate buybacks are another crucial flow. S&P 500 companies buy back approximately $800-900 billion of their own stock annually in normal years. This is the single largest source of equity demand, dwarfing retail or even institutional buying. When companies are buying back stock aggressively, it signals management confidence about business conditions and stock valuations. When buybacks collapse, it signals caution and potential distress. In 2008, buybacks fell from $560 billion to $150 billion as companies preserved cash during the crisis. In 2020, buybacks briefly went to zero as companies drew down credit lines and hoarded cash to survive COVID lockdowns. These collapses signaled severe economic distress visible in corporate behavior. When buybacks resume and accelerate, it signals improving corporate health and confidence. The buyback surge in 2021-2022 to over $900 billion annually reflected record corporate profitability and confidence, even if that confidence proved premature as inflation and rate hikes hit. Foreign flows matter too. Foreign investors own about 40% of U.S. stocks, roughly $20 trillion. When foreign money flows into U.S. markets, it supports prices. When it flows out, it creates selling pressure. Foreign flows are affected by relative economic performance, interest rate differentials, currency movements, and geopolitical factors. When the Fed is hiking rates faster than other central banks, foreign investors often increase U.S. equity allocations to capture both capital appreciation and currency gains from a strengthening dollar. When the Fed is cutting rates and the dollar weakens, foreign flows often reverse, seeking better opportunities elsewhere. These flow dynamics create medium-term trends in markets that reflect changing global macro conditions. Combining all these elements, leverage, derivatives, international correlations, currency effects, prices dynamic, and flows, we get a complete picture of stock markets as complex adaptive systems that process macro information through multiple channels simultaneously. Your $45,000 retirement account sits within this system. Its value reflects not just company fundamentals, but all these structural factors. Leverage buildups and unwinds, derivatives-driven flows, international capital movements, corporate buyback activity, and retail investor sentiment. Understanding this complexity doesn't mean you can perfectly predict market movements, but it means you can better interpret what market movements actually mean about underlying economic health versus technical factors. But we need to talk about something uncomfortable. Sometimes markets get it wrong. Sometimes stock prices send false signals about macro health. Sometimes they miss major turning points. Sometimes they create problems rather than just reflecting them. The 1987 crash is the classic example of markets lying. On October 19, 1987, the stock market fell 22.6% in a single day, the largest one-day percentage decline in history. Your $45,000 would have become $34,830 overnight. Catastrophic, terrifying, surely signaling economic disaster ahead. Except, no recession followed. The economy grew 4.2% in 1988. Unemployment fell. Corporate earnings rose. The stock market recovered and went on to new highs within 2 years. So what happened? The crash was driven by portfolio insurance strategies, programmatic selling, triggered by declining prices, creating a feedback loop that had nothing to do with economic fundamentals. It was a technical malfunction, not an economic signal. This is a crucial lesson. Not every market crash predicts recession. Sometimes markets malfunction due to structure, leverage, or panic that exceeds any fundamental justification. The flash crash of May 6, 2010 is another example. The stock market fell 10% in minutes, with some stocks briefly trading at absurd prices: Apple at $0.01, Accenture at $1. This was algorithmic trading gone haywire. High-frequency trading systems interacting in unexpected ways, creating a cascade of selling that had zero connection to macro health. Markets recovered within hours. The signal was meaningless noise. More problematic are sustained periods when markets diverge from economic reality. The 1990s tech bubble is the canonical case. From 1995-2000, the Nasdaq Composite rose 400%, while the economy grew at a decent but unremarkable pace. Stock valuations reached absurd levels: Cisco Systems trading at 150x earnings, Amazon at infinite multiples because it had no earnings. Were markets signaling incredible future economic growth? Partially, the internet did transform the economy, but mostly they were reflecting excessive optimism, momentum trading, and narrative-driven speculation disconnected from realistic profit expectations. When the bubble burst in 2000-2002, the Nasdaq fell 78%. That decline wasn't signaling recession. The 2001 recession was mild. It was correcting a previous overextension where markets had departed from reality. This teaches us that markets can stay disconnected from fundamentals for extended periods when powerful narratives drive speculation. The 2020-2021 period provides a recent example. Stock markets hit all-time highs in late 2021, while 10 million people were still unemployed from COVID. Supply chains were broken, inflation was rising, and the Fed was about to start the most aggressive rate hiking cycle in 40 years. Markets weren't seeing reality clearly. They were intoxicated by stimulus, zero interest rates, and the Tina narrative, there is no alternative to stocks. The subsequent 2022 bear market was reality reasserting itself. This reveals market limitations as macro indicators. They process information, but also create narratives, succumb to herding, and sometimes reinforce delusions through feedback loops. Central bank intervention creates another problem: moral hazard. The Fed put the expectation that the Fed will always save markets, distorts price signal. If investors believe the Fed will prevent any major crash, they take more risk than fundamentals justify. Asset prices rise beyond what cash flows warrant because expected downside is limited by Fed intervention. This means stock prices might not accurately reflect true macro fragility. They might be artificially elevated by implicit Fed support, masking underlying problems. This played out in 2018. Markets fell 20% in Q4 as the Fed continued tightening despite weakening global growth. When the Fed capitulated in January 2019, signaling they'd stop hiking, markets immediately surged 20%. What changed about economic fundamentals? Nothing significant, but market expectations about Fed policy changed completely, driving a massive price swing that had little to do with actual macro conditions. This Fed dependency makes reading market signals harder. Are prices reflecting economic health or just Fed policy expectations? Another challenge: markets can be manipulated. While outright fraud is rare in major markets, there are edge cases worth considering. In China, the government explicitly intervenes to support stock markets during crises. They ban selling by major shareholders. They have state-owned enterprises buy stocks. They coordinate buying through the national team of sovereign wealth funds and state banks. This makes Chinese stock prices unreliable macro signals. They don't purely reflect investor assessment of economic conditions because government intervention distorts prices. Even in the US, there's debate about whether Fed asset purchases and corporate buybacks artificially inflate stock prices. If half of equity demand comes from the Fed and corporations buying their own stock, are prices reflecting true investor assessment of value? These questions matter for interpreting market signals. The everything bubble concern of 2020-2021 highlighted this. Stock, bonds, real estate, commodities, cryptocurrencies, everything rose simultaneously as central banks flooded the system with liquidity. Were markets signaling strong economic health? Or were they just reflecting liquidity inflation, too much money, chasing limited assets, creating price rises divorced from fundamental value? The 2022 crash across all asset classes suggested the latter. When the Fed removed liquidity by hiking rates and doing quantitative tightening, everything fell together. The previous rises weren't primarily about economic strength, but monetary conditions. This is perhaps the deepest challenge in using markets as macro indicators. distinguishing real signals from monetary distortion. Finally, there's survivorship bias in market signals. We study U.S. markets because they've been successful for a century. But many countries had stock markets that went to zero: Russia, 1917, China, 1949, various nationalizations and expropriations throughout history. In those cases, stock markets signaled catastrophe, but only to investors who got out early. For those who held hoping for recovery, markets were devastating lagging indicators of political/economic collapse. The lesson: markets are best at signaling marginal changes in developed, stable economies with strong property rights. In unstable or transitioning systems, markets can fail catastrophically at their signaling function. Let's talk about where this is all going, because stock markets are changing in ways that will transform their role as macro indicators. Algorithmic trading now accounts for 60-70% of all stock market volume. These aren't humans processing macro information and making judged decisions. They are algorithms executing strategies based on price patterns, correlations, and programmed rules. What happens when most market volume comes from machines? Do markets still efficiently process macro information, or do they just respond to their own price momentum? There's evidence for both. Algorithms can process news and data faster than humans, potentially making markets more efficient at incorporating information. But algorithms also create flash crashes, momentum extremes, and correlation breakdowns when they all respond to the same signals simultaneously. The May 2010 flash crash, the August 2015 volatility spike, the February 2018 Volmageddon event all involved algorithmic trading amplifying moves beyond any fundamental justification. As algorithms become more sophisticated, incorporating machine learning and AI, this could go either way. AI might process macro data better than humans, making markets more informative. Or AI might create new forms of herding and instability as similar algorithms reach similar conclusions simultaneously. The rise of retail trading via zero-commission apps adds another dimension. Robinhood and similar platforms brought millions of new retail traders into markets during 2020-2021. These traders often act based on social media narratives rather than fundamental analysis. The GameStop/meme stock phenomenon showed retail traders could move prices through coordinated buying regardless of fundamentals. This injected noise into price signals, stocks moving for social/entertainment reasons rather than economic information. But retail traders also brought genuine liquidity and price discovery in some cases. Their willingness to trade against hedge funds exposed some market inefficiencies. The net effect on markets as macro indicators is unclear. More participants could mean better information aggregation, or it could mean more noise and narrative-driven trading disconnected from economics. Index fund domination creates another structural change. About 50% of U.S. stock market value is now held in passive index funds that buy everything and never sell based on fundamental analysis. This reduces active price discovery. If most money just buys the index, individual stock prices become less informative about company-specific conditions. The index level still matters, but internal allocation becomes somewhat arbitrary. This could make markets less efficient at micro-level information processing while potentially remaining efficient at macro-level signaling. ESG, environmental, social, governance investing is growing rapidly, with about $35 trillion in assets globally considering ESG factors. This introduces non-financial criteria into price formation. If large investors avoid fossil fuel stocks for ethical reasons, regardless of profitability, those stock prices no longer purely reflect economic value. They reflect values preferences plus economics. This could make sector signals less reliable as macro indicators if price movements reflect ethical investment flows rather than economic conditions. Central bank digital currencies, CBDCs, could eventually change how monetary policy affects markets. If the Fed could directly inject money into consumer accounts, bypassing banks and financial markets, the transmission mechanism would fundamentally change. Markets might become less central to monetary policy, potentially reducing central bank attention to market signals. Cryptocurrency and DeFi decentralized finance present alternative financial systems that don't rely on traditional stock markets. If significant economic activity moves to these platforms, traditional stock markets might become less comprehensive as macro indicators. Though currently, crypto markets themselves have become macro indicators, risk-on/risk-off signals similar to stocks, but with higher beta. Climate change presents the ultimate long-term challenge. Markets are generally good at processing information about the next 6-24 months. They're terrible at pricing risks decades away, especially risks that build gradually and then manifest catastrophically. If climate impacts accelerate, markets might be blindsided by risks they systematically underpriced due to their short-term focus. This would be market failure as a macro indicator on the most important macro issue of our time. So what does the future look like? Scenario 1. Markets become more efficient information processors through AI and big data, providing even clearer macro signals in real time. Scenario 2. Markets become more unstable and noise-dominated as algorithms, retail traders, and passive investing reduce genuine price discovery. Scenario 3. Markets become less centrally important as alternative systems, crypto, DeFi, CBDCs, handle more economic activity, reducing their macro signaling value. My assessment, probably a mix of all three. Markets will process some information better while adding new noise sources. They'll remain important, but not exclusively central. They'll evolve alongside other systems rather than being replaced. What does this mean for you and your $45,000 retirement account? First, markets will likely remain your best vehicle for long-term wealth building despite increased volatility and changing structure. Second, understanding macro signals will become more important, not less, as you'll need to distinguish genuine economic information from noise. Third, diversification across markets, strategy, and potentially alternative assets will be increasingly valuable as traditional stock market dominance potentially diminishes. Here's what strikes me most when I think about stock markets and macro health. That $20 in your wallet is a claim on real goods and services. But that $45,000 in your retirement account, what is it really? It's a claim on future corporate earnings that don't exist yet. It's a bet that the economy will continue growing, that companies will remain profitable, that the financial system will remain stable, that property rights will be respected, that contracts will be enforced. Every dollar of stock market value is built on expectations about the future. And those expectations are shaped by collective assessment of macro health, economic growth, inflation, interest rates, geopolitical stability, technological progress, demographic trends, and 1,000 other factors. Stock prices aggregate this impossibly complex information into a single number that changes every second. This is remarkable. No government agency could possibly process all this information. No economist could synthesize all these variables. No model could capture all these dynamics. But markets do it continuously, imperfectly, noisily, but with surprising accuracy over time. When markets crash, they are revealing collective fear about the future. When they surge, They are revealing collective optimism. When they churn sideways with high volatility, they are revealing uncertainty and disagreement. All of this is information about macro health that appears in prices before it appears anywhere else. But here's the paradox. Markets don't just reflect the economy. They shape it. When markets crash, consumer confidence falls, businesses delay investment, banks tighten credit, and recession often follows partly because the crash itself created the conditions for recession. When markets surge, wealth effects boost spending, businesses invest aggressively, banks lend freely, and growth accelerates partly because the rally created confidence. Markets are both thermometer and thermostat. They measure economic temperature and they regulate it through their effects on behavior. This creates a strange loop where stock markets signal macro health, which affects actual macro health, which changes stock market signals. We are inside this loop. Your $45,000 retirement account is tiny, but aggregate across millions of people, and household wealth shifts trillions based on market movements. Those wealth shifts change spending patterns, which affect GDP, which affects corporate earnings, which affect stock prices. You're part of the system, even if you don't trade actively. From a certain perspective, you're powerless. Your individual decisions can't move markets. You can't control whether your account is $45,000 or $35,000 or $55,000 next year. That's determined by forces vastly larger than you. But from another perspective, you're accessing the most sophisticated information processing system humanity has created. By investing in market indices, you're plugging into collective intelligence about future economic conditions. Over decades, this has created wealth for billions of people. The average investor who bought and held through multiple crashes, recessions, and crises has been rewarded because markets process information that, over time, reflects genuine economic growth and corporate value creation. This isn't guaranteed to continue forever. Markets could fail. The system could break. Future growth might not match past growth. But betting against markets is betting against human ingenuity, technological progress, and our collective ability to solve problems and create value. Stock markets aren't perfect macro indicators. They send false signals. They panic unnecessarily. They miss important risks. They can stay irrational longer than you can stay solvent. But they are the best real-time economic signaling system we have. Better than government statistics that lag by months. Better than economist forecasts that are frequently wrong. Better than consumer surveys that capture sentiment but miss behavior. Markets put money where mouths are. They force people to make concrete predictions about the future and risk real capital on those predictions. That disciplined money at risk makes markets more honest than surveys or models where being wrong costs nothing. Here's the essential truth. Stock markets reveal macro health through the willingness of millions of people to risk their capital based on their assessment of the future. When people are willing to hold stocks at current prices, it means they believe the economy will support those valuations. When they sell aggressively, it means they see trouble ahead. This simple mechanism, supply and demand reflecting expectations, creates a remarkably accurate, real-time macro indicator. Not perfect, never perfect, but better than any alternative we've devised. Your $45,000 retirement account connects you to this system. It's not just saving, it's a stake in future economic health. It's a bet on human progress. It's participation in collective intelligence about what's coming. And that's both humbling and empowering. Humbling because you're subject to forces you can't control: global macro trends, central bank policies, geopolitical events, technological disruptions. Empowering because you're participating in a system that, despite all its flaws, has created more wealth for more people than any alternative in human history. The next time you check your retirement account balance, remember what you've learned. Those numbers aren't just your savings. They're real-time signals about global economic health. They're aggregating information from millions of participants processing billions of data points across every economy, industry, and market. When the number is up, it's not just good for you. It's signaling that collective intelligence sees positive economic conditions ahead. When it's down, it's signaling concern, uncertainty, or deteriorating macro health. You can't control which way the number moves, but you can understand what the movements mean. You can read the signals beneath the surface. You can distinguish noise from information, technical factors from fundamental changes, temporary panics from genuine macro deterioration. That understanding won't make you rich overnight. It won't let you perfectly time markets or avoid all losses. But it will give you perspective. When markets crash and terror grips investors, you'll understand whether it's systematic financial crisis or just painful but normal volatility. When markets surge to apparent extremes, you'll recognize whether it's sustainable growth or speculative mania. You'll see the economic signals that most people miss. And over decades of investing, seeing those signals will help you make better decisions, avoid panic-driven mistakes, and stay invested through the volatility that terrifies others out of markets. Because ultimately, stock markets work as macro indicators because of something profound. They reflect human nature. Greed and fear, optimism and pessimism, confidence and panic. These emotional states drive economic behavior. When people are confident, they spend, invest, take risks, and create growth. When they are terrified, they hoard, save, avoid risk, and create contraction. Markets capture this psychology in real time. Price movements reflect not just rational analysis of data, but emotional responses to uncertainty. This makes markets beautifully human. Not cold, mechanical, perfectly efficient, but deeply, messily, powerfully human. Your $45,000 is part of this. Not just money, but participation in collective human effort to anticipate the future, allocate capital efficiently, and build prosperity. Thank you for taking this journey through stock markets and what they reveal about macro health. If you found this exploration valuable, please consider liking and subscribing. It helps the channel grow and allows me to keep making deep dive content like this. Remember, markets are imperfect, noisy, sometimes irrational, but they are also remarkably informative for those who learn to read them. Your retirement account isn't just your future security. It's your window into the collective intelligence of global markets, processing the most important question in economics. What will the future bring? Sleep well, and may you never look at those green and red numbers the same way again.